Hey traders, Mike Sir here. Welcome to my weekly Trader Psychology live stream series where I help you with the mental side of trading. All right, hope you guys are having an amazing weekend so far. Today we are going to talk about scaling in and scaling out. So the psychology behind scaling into trades and scaling out of trades. For those who aren't familiar with this term in terms of scaling in or out, essentially what it means is when you are entering into a trade, instead of putting a full size position, for example, let's say you want to buy 1,000 shares of XYZ stock, instead of buying 1,000 shares at one instance, you essentially look to build your position. So scaling, meaning you could divide your position into two positions or two 500 share positions. So instead of entering into 1,000 shares at once, you buy 500 shares at a time. Also, for scaling out is where you are not necessarily exiting your entire position, let's just say either at a loss or at a profit. So again, instead of selling 1,000 shares immediately, you sell half, maybe perhaps it reaches your first target price, and then leaving the rest to sell at a much higher price. Or if you're in a loss where you are taking half of your loss and then trying to ride out the losing trade and hopefully break even or make money on that trade. Now, there is a psychological aspect in terms of people not being able to scale into a trade and also scale out of trade or exit a trade. And this is exactly what I'm going to share with you guys today. So let's get started. All right, just normal disclaimer, please consult your financial advisor before making financial decisions. All right. So today, what I'm going to share with you is just it's like a brain hack. It's a way for you to be able to think differently when you are considering looking to build a position into a stock as well as exiting a stock. So let me kind of just share with you some of the challenges that people face. So when we talk about scaling in, for example, where we are trying to buy a position bit by bit, as I mentioned earlier, what happens is that let's just say you're very, very safe, you're very, very conservative, and for example, you wanted to buy 1,000 shares, but you're kind of scared. You say, well, I'm just going to maybe buy 100 shares. And then immediately once you got into that trade, the price goes up in your favor. Like shoots up. And you're thinking, oh man, I should have loaded up, right? I should have bought 1,000 shares. I should have bought 5,000 shares. I should have bought, went all in type of scenario. Because you would have obviously made a lot more money. When you are only buying such a small position, you don't really benefit, right? You don't really profit as much. So then you're thinking, okay, you know what? Next time I'm just going to play full size and I'm going to get in. Well, maybe perhaps the next time you do, let's just say 1,000 shares at a time, and obviously you have your stop loss in place to protect yourself, and the trade doesn't work in your favor. And then you should say to yourself, I should just slowly build into the position because it was very, very volatile. And if I slowly build into it, I'd be able to ride out this volatility and still be in this trade rather than being stopped out. And this type of a scenario is where you could possibly try once, twice, three times, how many times to get into a trade before the trade actually works in your favor. Now, if you are, I'll share a little bit. If you use the scenario where you bought bit by bit, you won't care about the volatility as much, right? Because the loss is very, very minimal. Obviously, you again still have a stop loss, but you'll have a much wider stop loss to be able to handle those fluctuations. Or another scenario in terms of a challenge, again, it screws up with your psychology is, let's just say you exit a trade, okay, where it reaches your target price, and you say, I'm going to sell everything, okay, and then you sit back, you're happy, all that stuff, and it keeps going higher in favor, right? And then you're starting to think, well, I should not have sold everything, right? Maybe I shouldn't have sold anything at all. I'm just going to try to ride this as long as possible, or try to maximize this profit as much as possible. But again, another scenario will happen, right? If you try to do that next time, is okay, you know what? I'm not going to sell, or I'm just going to sell a little bit. And then actually that was the peak. And then the price dropped against you, and you said, oh, I should have exited all my positions. I shouldn't have just taken a little bit of profit, or maybe I should have, considered selling, but I didn't sell, and now I didn't make any money. Well, have you guys had these type of scenarios, right? You always look back and say, oh, I should have done this. I shouldn't have bought too much, or I should have bought little, or I shouldn't have sold all, or I should have sold a little bit, right? You're always trying to question yourself. So what I'm going to share with you is some sense, kind of like some brain hacks to kind of help you reframe your mind in terms of doing that. Okay. So how I'm going to do that is, first of all, you have to, come to the realization you cannot predict the price. Okay. Whether you get in that full size position or whether you buy in bit by bit, you don't know whether that's going to be the ideal entry spot. Or when you sell your position, you don't know that's going to be the top, right? It could keep going higher, or maybe you were right. It is the top, right? So you can't predict that. So I want you guys to get rid of looking back and say, oh, I should have done this, or I could have done this, that type of thing. That won't help you in any way in terms of trading, because you're always looking at probability. You're always looking at something that is unknown, right? You don't know whether you're going to buy at the best price. You don't know you're going to sell at the highest price. So first of all, get rid of that scenario, number one. Number two, I'll share with you one of the reasons, one of the reasons why I really like to scale in and scale out. The biggest reason I'll share with you in terms of scaling in is it drastically improves the probability of my trades being profitable. I may not make the most money in terms of like a scaling in type of scenario, or I could be, but in general, what I have seen is that the probability of having winning trades through scaling in is much higher than versus me just trying to get in full size and exiting a full size position. The reason is, when I scale in, I'm not really I have a lot more margin of error to be able to withstand the volatility. So for example, let me give you guys examples. If, let's just say, again, I want to buy 1,000 shares, but let's just say I tippy toe in, okay? And I'll just use an extreme example. I'm only going to tippy toe in with 100 shares, okay? So I can buy 10 more positions, okay? If I buy only 100 shares, and let's just say I have a certain risk tolerance of, let's just say, I'll make this more extreme. Let's just say $500, right? For example, if I buy 100 shares, I can allow $5 to move against me before I exit. Okay, obviously, this is a kind of extreme example. You're not going to let the price go against you that much, especially if you are buying a stock that is not very volatile, or perhaps you're not going to be able to profit as much, right? For example. But what it does, it allows me to be able to withstand a lot more volatility, and therefore my initial position doesn't have to be as accurate. If, let's just say, for example, I don't want to lose more than $500 and I'm buying 1,000 shares, I'm only allowing a margin of 50 cents. So if it goes down against me 50 cents, I lose 500 bucks. And let's just say it's very, very volatile. It shoots you, cuts you out, and then shoots up in your favor. Then it's a trade that you missed out on. Okay. So it allows me to not be as accurate in terms of my entry level. Okay. And this is, excuse me, this drastically improves your confidence. You're not as scared. You're more relaxed, right? Because it's such a small position and you allow for volatility, then you're not as concerned. Okay. That's number one, making you feel confident. Number two, okay, the reason in terms of scaling in is what you guys don't realize is, say, when a stock that you buy a little bit, and it goes in your favor, what the market is telling you, Mike, you are right. You are right in terms of buying this stock because it's now going up. Now, obviously, you sometimes, it's psychology that really affects us. Is, let's just say you're at a supermarket. Okay, you see stuff that is for $5, for example, and then so you buy one. Next day, you see it $6. You see yourself, well, I'm not going to buy more because it's now more expensive, right? But what it's telling you is that the supermarket is telling you is, hey, Mike, you were right to buy it at $5 because it's now more expensive than what you bought it at. It's the same thing in terms of trading. You bought something at a price that is lower than what the current price is. And so what it's telling you is, hey, you're right to buy it at that price. So you should feel confident. You should feel comfortable. You actually feel good about yourself. But what screws it up, our way of thinking, is, let's just say we go to a supermarket, we see something that's $5. Now we buy one unit, and now you see it at $2.50. Okay, half price. Now you're going to buy more, right? Because it's cheaper than what you had. So what the supermarket is telling you, Mike, you're wrong. You bought it at too high a price. You should have waited for it to go lower in order to buy. But what we end up doing is, now we see it's 50%. We actually buy more. And that's wrong in terms of, as a trader in the markets, is it's the same thing. Like, you bought a stock at a certain price. Now it's 50% lower. You buy even more. Well, what if it keeps getting lower and lower and lower to a point where the company is worth zero, or the trade that you bought it is worth zero, right? You're adding more positions to an unprofitable trade. So that's where it screws up our psychology, is because we're programmed to buy stuff that's on sale, right? We're not programmed to buy stuff that is increasing in price, right? We like to buy stuff that's on sale. But in trading in the markets, that's not the right mentality. So that's why we have to fight against that. We have to kind of move that aside in terms of your rational thinking, in terms of everyday life, of buying stuff that is on sale. And there's a reason, if you kind of think about it, there's a reason why things are on sale, because nobody wants it, right? Why does the supermarket have to discount something 50%? Because it encourages people to buy, because at that price it was too high. So if you kind of bring that type of mentality to trading, is when you bought something at a certain price and now it's higher, what it's telling you is the price is going to go higher. And therefore, what you would do in terms of scaling in is, let's just say I bought 100 shares at $5. Now it's $6. I buy 100 shares more because it's agreeing with me. And let's just say, again, you look at your technicals, you look at your charts, you look at the overall market sentiment, all that type, right? And you see that it's all positive, right? It's on the uptrend. So why wouldn't you buy more? Because the market's telling you that you are correct. So that's what we have to fight against is when we buy something and like has to scale in, we have to be disciplined to buy more in terms of having a plan once the price goes in our favor. And we have to get rid of the habit of buying something at $5 and now it's $4, so we should buy more. $3 you buy more. Right? That won't work. Okay? In terms of as a trader. Now, as an investor, it might be a little bit different. You probably may have heard of DCA, dollar cost averaging, where you buy something that you like at a certain price. If it goes lower, you buy more. As it goes lower, you buy more. Now, it may work longer term in terms of that investment or that asset you believe will go up in value over time. But in terms of trading, that is a no-no. Okay? You can't do that. You only add to positions. You only add to your trade if the trade is going in your favor. Okay? And that's something that you guys need to be really concerned. So again, when you go back in terms of scaling in into a trade, think about the analogy I talked to you about in terms of the supermarket, and that will help you. Now, one thing before I talk about the scaling out is there is still a psychological challenge when we scale in, right? Because of the fact that we don't buy enough of a position. And let's just say you do add more to your position, you're always questioning yourself, well, maybe was I too safe in terms of adding it bit by bit? So that's where you need to pre-plan yourself and say, okay, I'm just going to scale into this trade. So what's my strategy? Am I going to split it up into 10 parts, buy 100 shares at a time if I want to buy 1,000 shares? Or do I want to split it in quarters, right? 250 at a time? Do I want to split it in thirds, right? 333 shares at a time? Or do I want to split up in just two positions, 500 at a time? So there's no right or wrong. It's really depending on your risk tolerance. If you want to be more conservative, and increase your probability of having the trade make money for you instead of losing, is to scale in bit by bit, like very little, 100 shares at a time, 10 shares. But you have to admit that if you do that conservative approach, you won't make as much, right? Because let's just say, you do only buy 100 shares and you never have a chance to, you won't have a chance, but you'll have to add to your positions. But if you split into 10 positions, you basically have to have a much longer time horizon to before for the price to get to a certain higher profit target in order to before you exit, right? Because you're scaling so slowly, versus a scenario where you are able to be a little bit more aggressive in terms of scaling. Let's just say just two positions at maximum. Then you can use some of those profits to be able to make even more money, right? So there's no right or wrong. It's just depending on your risk tolerance. All right. The next thing that I want to talk about is the scaling out. Okay, as I mentioned earlier, is if you don't, if you want to allow your position to be able to make more money for you, what you need to do is you can't exit your entire position at once. Okay. Now, that would mean that once you have a certain target price in mind, you won't exit all at once. So again, same thing. You could be exiting at two positions at a time. I'm sorry, split into two positions. Once it reaches this level, and then once it reaches higher level. You could split it into three times, or three positions, 4 or 10 positions, basically take profits along the way. Now, obviously, as I said, the challenge is that sometimes if you exit too slowly, by the time that, you exit your entire position, bit by bit, the price that you're trying to sell at has already kind of reached a peak and you're really trying to sell at, has the prices going against you. Versus a scenario where you maybe allow 2 or 3 positions, exit at one target price and then exit higher as it reaches higher prices. So what you can do in terms of this scenario is have 2, 3 target prices in mind. If it reaches the first target price, right, take it off. Now, if it doesn't reach your second target price, like goes higher and can't even, doesn't reach your second target price and then goes back to your first target price, then maybe at that point you can consider, okay, you know what? I'm going to exit my second position at that time. I have another position. So this way, you use your first target price has a guideline, has a support level. That if it breaks, then I'll exit. But if it keeps going higher and passes your second take profit price, let's just say, and then you exit, and then goes above that, doesn't reach your third target price, then use your second target price as a support level or your first target price. So then that way, it allows you to be able to lock in some gains if the price doesn't go in your favor. Now, that obviously is the best case scenario, right? As it keeps going higher, you keep taking profits. What if it's a scenario where it only hits your first target price and never reaches higher? And let's just say you divide it into 3 positions. So what you can do there is once it hits your first target price, you take some off and then set the rest of it to break even. Okay, so then that way, at least the trade will result in a profit for you instead of the trade resulting in a loss. So therefore, you're guaranteed a profit. Now, again, you'll say to yourself, well, oh man, I should have exited all at the first target price. Well, you kind of have to plan for that, right? If you said to yourself, okay, well, I'm going to exit at, split it into 3 profit targets, then I'm just only going to exit 1/3 at a time. And again, I speak from experience, and I know, some of the traders out there I work with sometimes, say, well, maybe I can change my plan if the market changes, right? Let's just say suddenly, you took the first target price, couldn't go high. You can see all the markets going lower, right? For example, then you can at that time decide, okay, you know what, change in strategy. Let me exit, right? Just because you see a fundamental shift in the market. So you can make changes, but don't make changes just for the fact you feel that, you're sitting on this profit. You're afraid that it's going to disappear. You're afraid that, let's just say you see yourself making $500. You took $250 off already. So now you have a $250 profit. Now you see the $250 profit only become $200. So you start being scared, right? Afraid that, the $250 profit will totally evaporate. So then you sell it all only to see that it was just a temporary pullback, and then it actually went higher. And that $250 profit that you took off, all of it, resulted in a $500 potential profit, right? Which was originally your plan, for example. So you can't, play armchair quarterback. In the past, you always have to know that you can't predict the future. You can't know how much you're going to make, but you have a plan in place to try to maximize your profits on every single trade. All right, guys, I'm going to take some questions from you guys. Let me guys know if you have any questions in terms of scaling in, scaling out. I'll be able to answer it. But hopefully I kind of given you an idea on the way to think when you scale in and when you scale out, because it's the way that it improves the probability of your trading win-loss ratio. You'll see that you win more than you lose. So this is a really great approach. All right, guys. So Dennis says, hi. Hey, Dennis and Richard. Hey, Richard. Hey, guys. So Richard asked, do all strategies support scaling in and out? Sounds a little dumb. No, I asked because scaling in has never helped my P&L. Okay. I'm glad you asked that question. So there is some scenarios where you may not want to scale in and you may not want to scale out. Okay, so you're probably thinking, well, why are you saying that? This is the whole purpose of this whole stream, right? Is to teach you guys how to scale in and scale out. It is incredibly hard to scale in with a very volatile asset that you're trading, a very volatile stock, a very volatile financial instrument, because if you're trading something that is yin yang, like this, up and down, like this, how can you scale in effectively? Because you buy a little bit, it shoots up and then shoots down, so and then shoots up, for example. So if you try to scale in, you scale in here and then you scale in more here, but then suddenly it goes rapidly against you. It's very, very hard to scale in when you are trading an asset that is extremely volatile. However, it can be done. You just have to be a lot more careful in terms of adding to your positions instead of sometimes adding it positions, at certain prices. Perhaps what you want to do is when you add to your position, the second position, you, instead of adding as it goes higher, wait for the pullback, okay, to happen where it gets back to a certain level, but that level has to still be higher than your original entry level. Okay, so instead of adding it higher here, wait for the pullback and then you add. Okay, so you have to be a little bit more careful versus a scenario where a financial asset is suddenly just going steadily up like this, right? Steadily up, like bit by bit, bit by bit. That is much easier to add. So it's not it's not easy, in terms of scaling in and out of a very, very volatile asset. So definitely agree with you, Richard. It's so obviously the best case scenario is to add in or exit out with a very stable asset. Okay, that's obviously most ideal. Now, the other thing that I will add to you is that, especially if you are day trading, it's if you are trading a strategy where you're just looking at very, very short term type of thing, you're not trying to find a whole trend throughout the entire day or the whole morning. It's very, very hard to add, let's just say, right at the market open when, again, things are very, very volatile. And also you have to find trends that are in place. So what I will have to say is that swing trading, position trading, it's much easier to scale in and scale out of. Day trading, it is possible for sure, but you have to be a lot quicker. Okay, and again, especially if you're trading a very volatile asset. So very, very good question, Richard. All right, Dennis says that the hardest part is believing you are correct, more importantly in correction moments. Yes. You're always doubting yourself, right? You always question, is my trade working in my favor? And obviously, sometimes it can be due to many other reasons, right? Psychological, confidence levels, lack of trading success, just the market not agreeing with you. So you have to separate. Like I have a belief, okay? Like I had a thesis. Now my thesis is not working that well at this moment, or just in the past month or so. That I believe that the market will end higher at the end of the year. Now, I don't think it's going to, the probability of my thinking that we're going to reach all-time highs again. At one point this year, I thought we could, but that type of thought has gone away. So when you have a certain thought, and especially the market's going down and it's now putting, and even though, let's just say we look at the charts and we see that it's still an uptrend, your confidence is a little bit more dimmed. Okay. What I would say to you is that I wouldn't be as aggressive, right? Let's just say I wouldn't be as aggressive adding to my winning position, for example. I may just, if I were to buy, I may be just buy in. If it has a quick spike up, sell. Thank you very much. Instead of the philosophy in 2021 is I buy, where do I add more? Where do I add more? Where do I buy more? Where do I buy more as it goes in my favor, right? Versus a market environment where the upward momentum is somewhat muted versus in 2021, right? Or for example, in 2022, where we were in a downtrend, right? So that's where we have to respect what the market's telling us, and then we have to adjust the way that we scale in and scale out. Is we maybe not be as aggressive, especially if the trend doesn't really show clearly, strongly in one trend or another. Okay, Dennis says, is it ideal to follow a last in, first out principle for scaling? So basically LIFO. Um, Not really. I mean, it really kind of again depends on your approach. How I would, maybe I'll restate what I said earlier is um, what you're really trying to do. Okay, I'll explain very simply. It's like a pyramid. Okay, you have this pyramid. You obviously want to have at the highest peak the most amount of shares, right? But you want to build that foundation first, right? So there's a philosophy of many. I'll give you a few things. There's a philosophy of you should buy your like a pyramid. You should buy your biggest position at the bottom, right in the initial, and as the position goes in your favor, you actually add less and less and less. So if you were to buy 1,000 shares, for example, maybe you would buy 500 in the beginning, right? 400 in a second, 50 shares, 25, 10, right? Bit by bit like that, right? So you buy your core position versus a scenario where you have it divided evenly, right? As I said earlier. Or another scenario where it's an upside down triangle, okay? Upside down triangle, I'm trying to make it, where you buy the least amount, but as it goes in your favor, then you buy more. So which one is right? Well, quite frankly, it depends, right? If the market is going very strongly in your favor, well, of course, the pyramid works the most, right? Works the best because you buy the biggest position at the bottom. So how I would say it is the pyramid type of example is where you feel the most confident, right? Because you buy the most, right? As it goes higher, you obviously reduce your risk as it goes higher, right? Makes sense. Versus a more defensive approach where the upside down triangle, where you're more defensive, you really want to ensure that the price is going in your favor. So you buy like very small in the beginning. Oh, okay, it's working. Okay, now you buy more, right? Because you're more convinced, right? But in that type of scenario, your risk is reduced, but your profit is also reduced, right? Because you're trying to buy the most amount of shares at the top versus you trying to buy the more shares at the bottom, right? So that's how you make more. And then the more balanced one is you split it evenly. Okay. Okay, exiting for scaling as well, same thing. As I said, Dennis, is do you want to be more aggressive, like to sell more of your position, once it reaches a certain target price, and then sell less, right? Or you want to sell it, in equal increments, or you want to sell it bit by bit, where as it goes higher in your favor, obviously you sell more and more, right? But again, you're assuming that the price will continue going higher. What if it doesn't, and you sell so little, right, at the top, and then you're forced to sell more, near the bottom, right? So again, it all boils down to how conservative and how aggressive that you want to be in scaling in and scaling out. All right, Richard says you're right. I trade pre-New York of XAU USD of gold. Yes. Okay. So I mean, gold is in a bull market, when I was trading gold, especially in the early 2000s, where basically prices were going in only one direction, right? It hit a low of 300, shot through 1,000, and then went even higher. So great way to kind of add. But nowadays, I actually don't trade gold that much because it doesn't move that much. So therefore, again, it's very hard to scale in. You're very welcome, Dennis. Oscar says, how do I scale out in where is it, in USD, since it's very volatile? Yeah, so I kind of talked a little bit about that. Is if you are trading a much more volatile asset, what you want to do is try to find points to get in, or perhaps, quite frankly, find an asset that is less volatile to scale in. And it's not, what I'm trying to say is that you don't have to necessarily scale in, scale out, right? Especially if you're trading a very volatile asset, perhaps you allow very little room for volatility. You get in full size, you only allow a certain margin error and to exit. Maybe that type of strategy allows you don't need to scale in, right? You can get full size. If it doesn't work, if it works in your favor, great. Like it keeps going in your favor, no need to scale. Once it reaches a profit, you take your profit. Thank you very much. Or when the trade isn't going in your favor, you exit immediately. You cut your losses quickly, and you're comfortable with that. But what I am kind of sharing with you in terms of scaling in and scaling out, to summarize, is it improves the probability of your win-loss ratio. You will notice that you will win more than you lose. Now, it might not necessarily, if you look at your P&L, it might not necessarily result in you making more profits. Okay, it could be, right? Again, it depends, right? If you're scaling in and you keep buying, and as it goes in your favor, you actually make more, right? Versus you buying and selling all your positions right away. But in certain market conditions, scaling in, scaling out works really well. Also, in volatile markets, scaling in, scaling out might not work the best, especially if you are swing trading, right? Holding positions overnight, where you have the markets go up one day, next day it goes down, next day it goes up, next day it goes down, right? That type of thing is very hard to scale. All right, guys, hope you guys enjoyed my live stream today in terms of scaling in and out. So what I'm going to talk about next week, if you guys have an ego, okay, and I will be the first one to admit that I used to have a big ego, because I was very profitable, got very cocky, got very confident. Is how can ego help you, and obviously how can ego hurt you? And that's what I'm going to talk about next week in the stream, and I'll share more of some of my experiences in how it's helped me, and obviously how it has made my trading a lot more difficult. All right, guys, thank you so much for attending today's live stream. Hope you guys got lots of information from this. Any questions, feel free to email me, put your comments in the comments section, and I'll be answering. I usually, again, read all these questions and answers. So look forward to hearing from you. All right, guys, enjoy the rest of your Sunday. Take care, and see you guys next week.